Hello, hello, and welcome to Paytm Money Talk. And the topic today is long-term wealth creation simplified through value funds. And it's a very exciting topic because we have got a very experienced, exciting guest whom I'm going to introduce slightly later. But before that, I'm just going to give you a small introduction to the topic. Now, when you talk about investing, there are different kind of investing styles. Talk about value investing, growth investing, momentum investing. So many of the investors are confused. Basically, new investors, they don't know which one is good, which one is to choose for. In fact, when you talk about value investing, some of the very famous proponents of this investing style is Warren Buffett, Benjamin Graham, Peter Lynch, Charlie Munger, and so many people. Although it seems to be easy and simple, but value investing has its own challenges and advantages. As an investor, if you're relatively new to the market and you are willing to take up value investing, this show is definitely for you. I'm Neeraj Gogoi, your host for the show, and I'm a trader, I'm an investor, and also an educator. And this talk is powered by Paytm Money. Okay, welcome back. So before we start, let me very quickly introduce what the Paytm Money Talk is all about. You know, Trading and investing is not about, all about trading methodologies or techniques. Many times it involves lots of, psychology, lots of experience, lots of wisdom. So here, what we do is we get the best minds from the industry with decades and years of experience and share their ideas, thoughts, and their experiences so that as a new investor, we can learn and we can move faster in our path to become a successful investor. So today in this episode, we have got Mr. Sanjay Chawla. He's a Chief Investment Officer, Bank Baroda BNP Paribas Mutual Fund. He started his career as an assistant editor with Capital Market magazine in 1992. So those who know, in 1992 there were two publications at those point of time, very famous. One is Capital Market, and second is Dalal Street Journal. So he became head of research and vice president with SBI Capital Market in 2004. He joined Birla Sun Life AMC as a fund manager in 2007. And currently, he is with Bank of Baroda AMC since 2013 as a chief investment officer. It's a great to have him here today. Welcome, sir, onto the show.
Thank you, Neeraj, and appreciate your kind words of introduction.
In fact, it's so we are so excited to have you today here, and we are not only going to talk about value investing, but we are going to ask you lots of questions about your experiences, how investing was there in 1990s and how it is now. What is the difference? How it has changed, and over a period of time, how the value investing have changed, right? So it's a great pleasure to talk to you here. So
Sure,
again,
sure,
yeah,
sure, Neeraj. I think I'm very excited to be on this platform and share my learning and experiences with you and your audience.
thank you so much. So when you talk about the market at present, we have seen lots of things are happening all around the world. When the whole world, Europe, America, they're on the verge of recession, and India is one of the brightest spot in the world economy today. Recently, we had got the inflation numbers; they were pretty much in control. We have got IIP numbers not very encouraging, and at the same time, we are in the middle of the earning season. Almost, we are coming to an end towards the earning season. So, how do you think going forward, Indian market look like? Do you think that we are going to make new highs sooner, or it might take some time? Probably, get into a complete uptrend, sir. What do you think about the market?
Sure. So, Neeraj, you've raised a couple of points, and I would like to address each one separately. Uh, you know, India has been an island of growth for the last couple of years. Uh, if I recollect, for the last 3 years, India has been probably the fastest growing economy in the world. And it's not very difficult to understand why it has been so. I think it's the demographic dividend which is paying off. One of the arguments that we keep getting is, look, the world is going through a recession because of COVID, and the implication in terms of excess liquidity which was being pumped in by all the central bankers. The truth is, COVID impacted us also as badly, and we probably had a lot more poorer medical infrastructure than most of the developed countries. But the resilience of the people to bounce back and come back has been the strongest in India. And that's something that we are witnessing even now as we speak. While world over, the economies are slowing down because of the higher commodity prices or the excess liquidity being withdrawn, while India's growth rate seems to be coming off a little bit, but it's nowhere close to the decline that we most of the developed countries are witnessing. I do believe that the markets are slaves to earnings, and we've seen these earning trajectory being more or less in line with the GDP growth rate. If we believe that India as a country will grow, and in my mind, I don't have a doubt that the GDP would increase. We can debate whether it's 5.7 or 6 or 6.3. It is translating into earnings growth. And if that's the case, then you will see the markets coming back. Uh, as an investor, I really don't bother too much in terms of the headline numbers, in terms of earning, whether market is making a new high or no. I really focus on the valuation. And in terms of valuation, even though we seem to be making a new high or at the new high, the valuations are more or less in line with the last 5 years average. The froth which we had seen historically has gone off. So I think we are in a very good state where the earnings growth is coming back much stronger than what we had seen in the last 5 years, but the valuations seem to be in line with the last 5 years. So it's a happy situation to be in.
Wonderful, wonderful. Sir, you have been in this market since 1992. I think around the time that Harsad Mehta thing took place, and you have seen the transformation around that time. We read it in the newspapers. There was a business line, and your magazine, Capital Market, used to say, Indian market is 30 years behind the Western markets. The developed markets in the world. And today, Indian market is probably ahead of those markets, or if not ahead, probably we are at par with the most developed markets in the world. Now, coming back to investing, so do you see any kind of change the people used to look at investing at those times and today? What is the change that you have seen, sir?
So, Neeraj, just to share an insight on a personal note, while I have been in the equity market from 1992, that's when I
Right.
started working. The truth is, I've been tracking the equity market right from the time I was in my 10th grade. So that's
Uh-huh.
1982. So that's when my family was not really aware. And that's when, while the others were sneaking out and watching movies, I was the one who was following the stock market. I've seen the entire system evolving in terms of the way the trading used to happen. Uh, was very excited to be outside the trading ring to see the outcry system, to the way it's evolved in terms of electronically matching. As an exchange, I've seen we are probably the largest exchange in the world in terms of volumes. But
Correct.
the biggest thing that change that I've seen is the evolution of the investor, where they're no longer treating investment as a speculative thing. There is a science, which is what I've always believed in. Uh, I think there's a definite science behind investment, and probably investment and the realization of the investors that it's really the only means of beating the inflation. So, unlike the past, where the retail participation was a lot less in the mutual fund, I've seen that the investors are willing to place their savings with the mutual fund industry and realize their financial goals. So, the degree of maturity of the investor has evolved very significantly. Uh, it has been earlier dominated by a lot of operators. And earlier, the cycle used to be that we used to see 1 year of bull run followed by 4 years of bear market. And invariably, the bull market always ended with some scam coming through, right?
Right.
So you spoke about Harshad Mehta. I can talk about Ketan Parekh. We'd seen the Y2K bust also. But I think the maturity of the investor has evolved over a period of time. They realize that equity investment does carry risk, but eventually it tends to pan out if you are invested for long term. And I think that's something really commendable. So despite the COVID, uh, I've seen the investors sticking to their financial goals, and I believe they are the ones who are really making they're getting the benefit of their investments out there and realizing their financial goals.
Wonderful. Now, sir, coming to the main topic of discussion today, that's value investing, sir. So we have got different methods: growth investing, momentum investing. So first, can you just, in a very simple word, tell our audience what the value investing is all about and how it is different than momentum or growth investing?
Sure, Neeraj, it's a very interesting question, and it's how you go about investing. I don't think there's one single method which is right or wrong. So
Mhm.
first, let me define what is value investing. Value investing is nothing but identifying and investing in stocks that are underpriced or at a discount to the intrinsic value. This is different from growth investing, where you're focusing on the growth rate of the company. The starting point is the growth rate, and then you look at the valuation. And then you can have different philosophies, something what we call the growth at a reasonable value, etc. So the starting point of investigating or looking at a company is different. So if we believe inherently uh, the stock is undervalued compared to its intrinsic value, then you would start looking at it from a value perspective. And there are multiple reasons for a company to be below its inherent value. For example, if I look at it from a market point of view, there could
Mhm.
be fear in the market. During the global financial crisis, the markets came down to a very low P multiple compared to the average. So that inherently told me that it is value investing. The entire market was in the value zone. I do believe that there's no right investment strategy. I think both the strategies work, the growth strategy as well as a growth value strategy. Uh, as long as your time horizon is over the period of time, both of them have seemed to have delivered returns. The question is arises, look, if both of them tend to do well, why should you be looking at either or of them? The reason why you need to look at either growth or momentum, and I believe you need to have a combination of both, is because the time cycle for both of them differ. So usually when the growth does well, the value may not do well, and vice versa. So more from a diversification point of view from the investors, you need to have both strategies in place. Just the way you have a diversification in terms of sectors and stocks
Mm.
or market cap, your investment style should also have diversification. And I believe there's room for both growth as well value investing.
I think
Yeah.
that is fantastic. That is what insight that we are looking for. You said, yes, we need to diversify our portfolio across sectors. In fact, in terms of style, also we can diversify, right, sir?
Absolutely.
Now, now, like, Okay, we have experienced, or we have learned that trading and investing has got lots of to do with psychology, our temperament, our personality. Now, what kind of personality is required, what kind of psychology, what kind of mindset that is required to become a very successful value investor, and what kind of mindset that is required for a growth investor? Both, if you can give us some insight to that.
So, you know, a typical value investor needs to be a little more patient than a growth
Mhm.
investor because there are two elements. Element number one, uh, and I think it's very important that I really redefine value investing, because the conventional wisdom of value investing is you're looking at cheap stocks. Okay.
Hmm.
I don't think that is value investing. That can
Correct.
actually lead to value trap, and maybe we can discuss about value traps also. So according to
Right.
me, a stock which is below the intrinsic value, and there could be a merger, demerger, there could be change of management, and you can see potential value unlocking happening. So when we are looking at value investing, there are two elements. A, while you see value, we need to see the larger audience or the larger market participants also to see that value coming through. And when that
Hmm.
value gap is narrowed down, that's when you start realizing the real potential. Over and above this, just because it's a value stock, that doesn't mean that we are going to ignore the growth numbers. A value stock without growth can potentially be a value trap. So it's very important that any investor who wants to be a value investor needs to have a lot more patience out there, because there could be a timing difference between what you perceive value and what the larger audience or the market participants perceive it as a value. So the patience which the investor needs to have, or the time horizon of investment, needs to be a little more longer. Obviously, growth seems to be running quite well, and therefore, somebody who wants to diversify from the growth strategy, you need to have a value investors. And typically, a value stock, you will see some bit of a re-rating happening. You tend to make maximum money in the market when the market moves from disbelief to belief, and you have the growth coming back. And that's why that's the style of investment for a value investor. A growth investor will be looking at the growth, and he can actually track it on a quarterly basis or an annual basis. And that's the time horizon can be a little shorter to really react to if things are not going as per the hypothesis. And that's the key
Okay.
difference that we are looking at.
Correct. So we are going to ask you questions because BNP Baroda BNP is going to launch, or it's already we have launched an NFO for a value fund. We are going to ask you some questions on that. But before that, one more questions I would like to ask you. Like historically, which type of investing style tend to give a better return? I'm not saying that one is good or one is bad, but anyway, which seems to be more convenient or tends to give better return between value and growth?
So just as I said, both tend to do well over the time horizon. Uh,
Hmm.
However, if I really look at it from a theoretical point of view, a value investing would have a re-rating as well as a growth element out there. And if I look
Right.
at it from an index perspective, if I compare, say, Nifty 50, and there's a
Hmm.
value index called Nifty 50 Value 20, in 12 out of 14 financial years, the value index has outperformed the underlying Nifty 50 index. So
Hmm.
there is a case for looking at value investing.
Okay, great.
And that's how it
Okay,
stand out.
wonderful, sir. Now again, say your value fund, Baroda BNP value fund NFO from 17 to 31st of May. So can you give a little bit of introduction to the fund, and what is the investment philosophy? What are the investment objectives? and how probably it's going to be different than the existing value funds that we already have in the market?
Sure. So, Neeraj, that's a great question. Just as I said, we will follow a value investing philosophy for our Baroda BNP Value Fund. Uh,
Right.
our way of looking at value investing is slightly different from the market. We believe that we need to identify companies and sectors whose
Hmm.
inherent value or the intrinsic value is lower than the current market price, and therefore we hope to get a re-rating and the some bit of a growth coming out there. uh, there can be various reasons why either the market is at a discount. We've seen global financial crisis, we've seen COVID times when the market is at a discount, or it could be a sector which is out of flavor. For
Hmm.
example, IT sector is out of flavor right now. And we've seen that in the last 20 years, there have been five instances where the IT sector has come back to lower than its historical valuation, primarily because of the global factors. And every time the sector has done extremely well when those factors have been reversed. Do I believe that there's inherent value in that? I think yes, there is. And those are the things that we would really look at. So we hope to generate wealth over the long term by investing in stocks, looking at on the value parameters, and there could be multiple valuation parameters. We could be looking at discounted cash flows, P ratios. We could be looking at value unlocking opportunities.
Hmm.
Of course, we will look at companies with strong fundamentals across market cap. So it will be a flexi cap approach, and we'll have strong screeners to make sure that we weed out value traps that can potentially be creeping into the overall screeners. And it's a very important point that I'm making in terms of value traps. So we are not looking at companies just because they are cheap. If they don't have growth, then they are value traps.
So I want you to explain a little bit more on the value traps. Many of our viewers might be a little bit confused. Of course, we are trying to get a little bit of understanding, okay, what the value trap is all about, and I'm sure it's very important part of your whole decision making process. So can you a little bit elaborate a little bit more with few examples?
Sure. So let me
Yeah.
just explain what is a value trap. You
Yeah.
invest in a company which appears to be trading at a discount. Uh,
Hmm.
So you should be questioning, why is that company trading at a discount? Are there any fundamental factors, or it's the poor fundamentals that we have? And if I look
Correct.
at Indian markets, they essentially uh, most of the emerging markets are growth oriented. So having a company which is trading at a lower multiple and a lower growth, then that can be a value trap. So then naturally the question arises, how do you avoid a value trap? The simplest
Hmm.
way is you don't look at a single valuation parameter. So you just don't focus on the P multiple. You do a thorough due diligence on the fundamentals of the company, of trying to understand what the company is going through, what are the cycles out there. Try to understand what is the industry going through, and of course, you look at companies with a sound management. So let me just back it up with an example. If you have a lubricant company, okay, for the past 10 years, okay,
Hmm.
it's an automotive lubricant company, MNC management. The stock has derated from 37p multiple to 12p multiple. One would be
Hmm.
very tempted to look at this company and say, hey, this is a great value buy. But when you sit down and analyze the entire scenario, in the 10-year time horizon, the volume growth has been 2%, when the nominal GDP growth has been close to about double digit, right?
Hmm.
More than 10%. So obviously, it's a value trap. And if you look at the performance of that stock in the same time period, it's been less than 1% return, while the equity market has given you more than 13% return during the same time period. So that can be a classical value trap that you have out here. So you need to be careful. You need to have somebody who can look at look through data, and just because it is cheap, it's not a value.
Wonderful. So it's not that we people have the tendency, okay, look at the P, probably you have to look at much more, quite a few more factors, parameters, as you said. And then, you have to have a proper research. And then you come to a conclusion that this is the right value peak probably. So you have
Absolutely.
said again, then value investing opportunities can arise across, markets, sectors, stocks. Now you have already spoken about pharma, IT sector. Similarly, you have got different other sectors as well. So at present, where do you see, which are the sectors you see value investing opportunities at this point of time? Again, I would like to request our audience also कि अगर आपका mind में कोई questions है, if you have got any kind of questions, please feel free, go ahead, type your question in the chat box, and Sanjay sir would love to answer your questions. Yes, sir. Over to you.
Sure. So, Neeraj, the value can arise in three different buckets. One is at the
Right.
market level. Whenever there are
Mm-hmm.
crises, we've seen the markets giving you an opportunity. You have sector level opportunities where, there
Mm-hmm.
can be temporary challenges. There's a raw material shortage, there's a disruption, there's a regulation change. For example, during in the insurance side, we've
Mm-hmm.
seen some regulatory changes during the budget, and suddenly the sector goes out of flavor. Uh, we do believe that going out
Mm-hmm.
of flavor is a temporary phenomena. The business and the
Mm-hmm.
opportunity continues to be huge, and it'll come back. Similarly, on the IT side, I did talk about the global challenges. We've seen the IT companies, the Indian IT companies, something that the global companies cannot do without. They will come back as soon as there's some confidence coming back into the system. So, as and when the global growth revives, you will see them coming back out there. Right now, we are seeing opportunity arising in the pharmaceutical sector per se. If you look at the post-COVID time period, because of the high COVID base, uh, the growth rate appeared to be lower. Secondly, we had certain challenges in the US market in terms of the price erosion. We are already seeing early signs of the price erosion being lower. At the same time, the sector is actually underperformed. So I think it's a great opportunity in terms of value investing to look at that sector. So that can be another interesting space. Yeah, and then the third level could be in terms of stocks. They could be the conventional mergers, acquisitions. They could be turnarounds, some capacity coming on stream, and suddenly the opportunity that can be there can be huge. So let me back it up with an example in terms of stocks without naming a company. We've all seen how the crude prices have come down from about $100 plus to about 75 to 80. So what a lot of people have missed out is not only has the crude come off, but also the allied products like LNG, gas prices have also come off. So there's an entire value chain that you have which can actually benefit from this. And that can be a very interesting opportunity to invest in. Yeah.
Okay. So now coming back to your fund, a specific fund again, because the value investing requires lots of research and lots of working. Again, coming to expense ratio, because that again impact our funds return. What is going to be the expense ratio, and how do you think it's going to impact the overall return from your funds?
So, Neeraj, after the regulators define the expense ratio depending upon the size of the funds, that can be in line. So, there are various
Mm-hmm.
cutoffs up to 500, between 500 to a certain limit, and 5,000 crore and above. So, that is defined by the regulator. I think it's very important to understand whether the fund is adding value over the underlying benchmark. As
Mm-hmm.
long as that is happening, the investor should not really be too fussed about it. But the cap is definitely defined, and I don't think that is really impacting the return profile of the investor per se. So, depending upon what AUM we collect, that's how the expense ratio would pan out.
Right,
but
right.
it would
Okay,
definitely be under the regulatory framework that we have. And that's
correct.
how the regulator is defined to protect the investor's interest.
Yes. Now again, we talk about again performance. Historically, how the value funds perform compared to broad-based market or the benchmark. That
So interestingly, Dheeraj, one of the reasons why we are launching this fund is because we do believe that we can make a difference in this segment.
Mhm.
Unlike the conventional funds, which are looking at a different way of value, where most of them may consider value investing as cheap investing, we are looking at a differentiated way of investing, where we believe that we it's like an iceberg where you're not just looking at the P ratio, but we want to go below that and look at a differential way in a more holistic manner of investing, whether it's in terms of the sector or the industry. So you will look at the market cycle, you will look at the business cycle, you'll do the company specific factors. Then you get into demergers, mergers, acquisitions, restructuring, and the recovery potential. So that could be a big differential that we would be having in our fund. And that I think can be a differentiator compared to what are the other value fund guys are doing.
correct. And again, like how value funds or and again your fund likely to perform during the downturn of the market when the market corrects significantly. What is normally the behavior of the value funds? Do they correct more than the underperform, outperform, or same as the market? How do they behave, sir?
So, you know, if you look at it philosophically, any of the
Hmm.
value investing that we do, we will be looking at companies which are less discovered by the others, which would
Right.
mean that they are trading at a valuation lower than the market price.
Correct.
Invariably it would mean that they are less owned by the institutional investors, and the chances of volatility in the stocks that we own would be a lot less than the broader market. And if that's
Hmm.
the case, then the downside is protected a lot more than some of the other growth oriented companies, where
Correct.
the chances of a P compression is a lot more in a growth oriented
Hmm.
company compared to a investing, value oriented companies. So
Right.
I think by and large, uh, the fall, if the market corrects, should be a lot less than compared to the other high P stock companies that are there in the portfolio.
Okay. So one of the cushions, we can have a relative cushions as an investor if we have value funds, basically value funds provide. So again, what kind of portfolio are you looking for a concentrated kind of a portfolio or a very diversified approach, diversified portfolio? You have said that across sectors, of course, you are going to find values. So what kind of investment philosophy that you are going to follow in this fund, sir?
So the approach to investment would be a flexi cap approach,
Yeah,
which will be flexible across the market cap, and depending upon the opportunity arising, we could find some value whether it's in large, mid, or small cap. And historically, we've seen that value could be emerging because the mid caps are cheaper than large cap, or the small cap is more expensive than mid cap or the large, and some of the opportunities out there. uh, it would be diversified across the sectors. In terms of concentration, uh, our style of investment at Baroda, BNP, Paribas, AMC has been, we tend to run the portfolio with about 40 to 50 stocks out there. So that's the investment style, and that's how we define a risk framework also. I don't think the value investing would be any different from our conventional risk framework portfolios. So that's how we're going to be focused on this fund.
okay. And okay, now Again, coming to methodology, you've already spoken about different valuation parameters, right? In selecting, identifying value stocks. Can you trust giving us more light into the whole methodology? What are the methodologies that you are going to follow?
So it's a very interesting question. So as a house, we follow what we call the BMV principle. We look at
Mhm,
businesses, we look at management, and we look at valuation. So that's
mhm,
the broad investment framework that we have. Over and above this, we will be running couple of screeners in value investing while we're doing value investing in this particular fund. So the first filter, of course, would be to look at companies with strong fundamental and look at the growth opportunities. Uh, we use what we call the business screener. The second screen that we would be using is we're going to look at the valuation screeners. We try
mhm,
to look at undervalued companies using the most suitable valuation technique. Each sector or stock could have their own nuances, so we need to look at that. And the third one is we need to have the red flag filter or the screener. That is, we need to eliminate all the value traps out there. So while this is the guiding principle, how do we look at the basic when we are looking at the companies? We are looking at the 3S framework, what we call the margin of safety. And
mhm,
if you start off by quoting Benjamin Graham, who's actually the guru for Warren Buffett, and just to quote him, to distill the secret of sound investment in three words, it is margin of safety. And we've taken that to our heart. So we are looking
mhm.
at safety, which is the core of the investment philosophy. So we are looking at margin of safety in the balance sheet. We are not going to be looking at any company which is overtly leveraged, which is reasonable, or which is financially sound. We are looking at margin of safety of earnings, because if you're looking at a cheap stock which does not have earnings growth, then it's a value trap. So there should be reasonable
Mm.
confidence in the earnings growth. And of course, the key parameter would be the margin of safety in valuation, which could be based on the relative valuation that we have. So those are the broad investment approach and the philosophy for a value fund that we would be looking at.
Okay. Now, in fact, I would like to request our audience also, if you have got any questions, please feel free. Go ahead, type your question in the chat box, and I'm going to pose this question to Mr. Sanjay sir. So, again, you talked about red flag. Now, this is again purely from layman's investing perspective. So when we invest in a particular stock, which are the red flags? We know that in the recent last few years, there are so many cases that has happened. People have really burned their fingers like anything. Companies that we trusted completely betrayed. So when you talk about red flags, up, what are the important red flags that investors should look out for? Okay, if this happened, then no matter what, we need to move out.
So, Neeraj, in the last 30 years, I've seen so many disasters, and very important to learn from each and every one of them.
Right.
One thing which we need to be very clear is on the quality of the management. And this is
Mhm.
particularly true for mid and small cap, where it's very important to assess the quality of the management. And when we are talking about management, we need to look at it all across in terms of how do they treat the minority shareholders. And trust me, as institutions, we are a minority shareholders, not just the retail public. So how do you assess that? And there's really no science or art. You look at the balance sheet, you see how they're treating the uh,
Hmm.
employees. We have a constant dialogue with their channel partners, whether they are the dealers, etc., to find out how the payment terms are moving and how are they being treated. Because all said and done, they are in a position that they can give you a lot more unbiased view and feedback. And whenever there's a corporate governance issues, you just need to dump and move on. It does not matter what it is. You need to differentiate between what is a permanent damage and what is a
Hmm.
temporary damage.
Hmm.
Invariably, people tend to treat the temporary damage because of a change in regulation and how the company can react to it, with which are temporary dampeners, and treat it as a permanent effect. The case in point, I mentioned that in the present budget, because of the insurance being taxed at a higher level, people may tend to ignore the insurance sector for a shorter period of time. But if I look at the insurance sector per se, the penetration, or the rather the under penetration and the opportunity for growth, it is huge. So I do believe that sector can really come back out there. But if there's a corporate governance issue, you just need to sell off and walk away, no matter how much you have to cut your losses.
Absolutely, absolutely well said, sir. There's a question from one audience, investment horizon. Does the fund manager have a long-term investment horizon, and how patient is a fund manager in holding undervalued stocks? Uh,
So that's a very interesting question, sir. So typically, as a fund manager and as an investment house, whenever we are making the investment, our time horizon is usually 3 years. We actually
mhm,
have a visibility for 5 years when we're investing. And it's a continuous process of evaluation, quarter after quarter. It's not that I buy a stock and I expect the return to happen in the next 5 years based on my investment thesis, but I'm not going to monitor. So every quarter, every month, we track what is the investment thesis. Is it panning out exactly the way it is supposed to pan out? If it's so, uh, the stock price, we believe, is a outcome. It's not the primary reason. Uh, if the stock price does not react the way we think we would have expected, then it's perfectly fine as long as the investment thesis is intact. And that's something that we track consistently over a period of time. In case of a value fund, just as I mentioned, because we expect the re rating to happen, and there could be a time gap between what we think the stock should be trading in and the way the market should be reading it. We were suggesting that you should have a minimum 3 years of time horizon for investing in this fund.
Okay, great. Actually, sir, I think we can go on and on and on discussing with you the kind of, the experience, the wisdom that you have gathered over your experience, decades of experience in the market. It's really extremely valuable. So, again, your advice to investors now, not with respect to value investing, but as a whole, there are so many new investors coming to the market of late, young. Many people want to make quick money in a short period of time. But again, finally, over a period of time, they will realize probably what they need to do in order to create wealth in the market. So, again, to help them, what is your advice in terms of investing? What should be the right approach? What should be the ideal approach? I don't say right approach. What's the but the balanced approach one need to adapt if they don't want to make mistakes in this market, in the world of, in the field of investing? And of course, about investing in the value as a whole, what's your advice, sir?
So, Neeraj, great question. And, my advice to all my young investors would be: A, you should be investing for a particular goal. You need to
Hmm.
define why you're investing and set your financial goal. Once you've defined your financial goal, you need to have a plan of how you're going to achieve that financial goal. I do believe that equity market is probably one of the best way to beat inflation over a period of time, which takes me to the next level. You need to have the discipline of how you're going to be investing, and you need to stick to that discipline. And as long as you're sticking to the discipline, to the plan that you've made out, you will eventually get the financial goal. There could be
Hmm.
market volatility. You need to be mindful that it's equity market. It's not going to be in one direction, because markets are driven by sentiments, uh, which is driven by greed and fear. As long as you're consistent in your investment approach, eventually you will realize your financial goal. As long as you're very disciplined out there, uh, there is no shortcut to becoming rich. Trust me.
Right. So it was a great pleasure talking to you, sir. I'm sure our audience, we have learned a lot today from your experience and expertise that you have gathered, sir. Thank you so much, and also would like to thank all our participants, all our viewers for being a part of this program, and looking forward to see you all. Thank you so much, sir. Thank you.
Thank you, Neeraj, and thanks for the audience for being patient and listening to what I had to say. Thank you.
Thank you, sir.